You've done the research. You've found the company. You're ready to invest your hard-earned capital. You open your brokerage app, you type in the ticker symbol, and you're faced with a choice that stops 90% of new investors in their tracks. Market, limit, stop loss. These aren't just buttons. They are strategic commands. They are the language you use to speak to the market. And using the wrong one is like shouting buy when you meant to whisper sell. Welcome back to Alpha Index, the channel where we decode the hidden wisdom of the financial world to give you an edge. Today, we're pulling back the curtain on order types. Mastering these is the fundamental difference between gambling your money and strategically investing it. This isn't just theory. This is the operational skill that protects your capital and unlocks new opportunities. Let's start with the two most fundamental commands: how you enter the battlefield. First, you have the market order. Think of this as walking into a store and saying, "I'll take it, whatever the price tag says." You are telling the market, "I want to own this stock right now, at the best available price." The advantage? Speed and certainty of execution. Your order will almost certainly be filled instantly. But here's the hidden risk: slippage. In a fast-moving market, the best available price can change in the milliseconds between you clicking the button and your order being processed. You might intend to buy at 100 a share, but end up paying 100.15. It seems small, but over many trades, that's your profit margin being shaved away. It prioritizes speed over price. Now, contrast this with its strategic counterpart, the limit order. A limit order is like walking into that same store and saying, "I'll take it, but I will not pay a penny over 99. You set your maximum purchase price or your minimum selling price. You prioritize price over speed. Your order will only execute if the market meets you at your specified price or gives you an even better one. The principle here is control. A limit order is your declaration of value. You're stating what a stock is worth to you. The trade-off? Your order might never get filled. If the stock you want to buy at 99 never drops from its current 100, you're left on the sidelines. So you've placed your limit order. How long should that command stay active? This brings us to the element of time. The most common is the day order. It's exactly what it sounds like. Your order is active for one trading day. If it's not filled by the time the closing bell rings, the order vanishes. It's a fresh start tomorrow. This is the default for most brokers, and it prevents you from accidentally buying a stock weeks later because you forgot about an old order. But what if your strategy is longer term? What if you believe a stock is worth 150, but it's currently trading at 200? You don't want to log in every single day to re-enter that order. For this, you use a good till canceled order, or GTC. This order remains active day after day, week after week, until you either manually cancel it or it gets filled. This is the tool of a patient investor who has a firm price target and is willing to wait for the market to come to them. It's your standing instruction, working for you in the background. Now, let's move from the mechanics of buying to the principles of risk management and advanced speculation. This is where the real wisdom lies. The single most important order for preserving your capital is the stop-loss order. If a limit order is how you get in, a stop-loss is your pre-planned escape route. Imagine you buy a stock at 100, believing it'll go up. A stop-loss order is a dormant command you place at, say, 90. If the stock price falls and hits 90, your stop-loss activates and automatically turns into a market order to sell. It gets you out of the position to prevent further losses. Let me be clear. This is not about admitting defeat. This is about financial discipline. It's your emotional circuit breaker. It prevents a small, manageable loss from turning into a catastrophic one because you were clinging to hope. Every professional investor knows their exit point before they even enter a trade. Now, what happens when thousands of these ejector seats are triggered at once? You get a long squeeze. Imagine a stock is slowly declining. It hits a key price level where many investors have set their stop-loss orders. The first wave of stop losses triggers, creating a flood of automatic sell orders. This new selling pressure pushes the price down even further, faster, triggering the next wave of stop loss orders below it. It's a cascade, a domino effect of forced selling and panic that squeezes out the long investors, those who bet the stock would go up. It's a brutal, but important market dynamic to understand. But what if you want to bet on that decline? What if you believe a company is overvalued and is destined to fall? This brings us to one of the most misunderstood strategies: shorting. In a normal transaction, you buy low and sell high. When you short a stock, you flip the script. You sell high and then you buy low. How is that possible? You do it by borrowing. You borrow shares of a stock from your broker, let's say at 100 per share, and you immediately sell them on the open market. You now have 100 in cash, but you also have an IOU to your broker for those shares. Your thesis is that the stock will fall. If you're right, and the price drops to 70, you can now buy back the shares on the market for 70, return them to your broker, and you pocket the 30 difference. You profited from the decline. But this strategy carries a terrifying, unique risk. When you buy a stock, the most you can lose is your initial investment. The stock can only go to zero, but when you short a stock, there is no theoretical limit to how high its price can go. And since you must eventually buy back the shares to return them, your potential loss is infinite. And that infinite risk has a name: the short squeeze. This is the short seller's ultimate nightmare. It happens when a heavily shorted stock does the exact opposite of what they predicted. It doesn't just go up, it explodes upwards. Suddenly, all the short sellers are losing money rapidly. To stop the bleeding, they have to exit their positions. And how do they do that? They are forced to buy back the stock. This creates a vicious cycle. The original price increase forces shorts to buy. Their frantic buying creates even more demand, which launches the stock price even higher. This, in turn, forces more short sellers to buy back their shares at even more painful prices. It's a tidal wave of buying pressure, fueled by their own panic. We saw this play out dramatically with stocks like GameStop, where armies of retail investors identified heavily shorted stocks and squeezed them with incredible force. Market, limit, stop loss, shorting, squeeze. These aren't just vocabulary words for a test. They are the levers of control. They are how you tell the market your intentions, your price, your timeline, and your tolerance for risk. Choosing a market order when you need a limit order can cost you money. Forgetting to place a stop loss can cost you your account. Understanding the dynamics of a squeeze can help you avoid it, or even understand it as an opportunity. Here at Alpha Index, we believe that the path to financial freedom isn't paved with hot stock tips, but with deep fundamental knowledge. True alpha comes from understanding the system better than the person on the other side of the trade. If this video helped you decipher the language of the market, do me a favor and hit that like button. Share it with a friend who is just starting their journey. And for more hidden wisdom that gives you a strategic edge in finance and investing, make sure you subscribe to Alpha Index and ring that notification bell so you never miss an insight. Leave a comment below. Which of these order types do you feel is most underutilized by investors? I'd love to hear your thoughts. Until next time, invest with intelligence.